Thank you for tuning in to the second iteration of the April Fool's Economic Update. This is a follow-up from an event that actually took place on April 1st, originally intended to take place every 6 months on Halloween and April 1st. It was originally hosted by Len Brandt and his family, including Karen and Rayanne. And it's being technologically hosted by GIVSUM. Thank you to those folks. And it's benefiting Fish for Life. In the chat on the right-hand side, if you click on the chat button on the bottom of your screen, you can see the opportunity to donate for Fish for Life, which is a 501c3 that takes special needs students and one of their family members out for a day of fishing, and they do a red carpet. It's a really great thing that they do. And what we're following up on is the economic prognosticating and suggestions we had on April 1st that some of you might remember if you got to tune into that. But basically what we were suggesting that night was that everybody who can refi their home mortgage, because these are all-time low interest rates, and that they switch from passive fund management to active fund management. Since then, the big economic news that's made all the headlines is from the Chicago oil pit, where for the first time ever, oil had a negative price. And what that means is that people who own warehouses, economically speaking, were paying drillers to keep their oil, i.e. not to, they didn't want to take deliveries, so they actually gave producers of oil $13 a barrel not to deliver the oil. The reason for that was that the world has run out of storage. The other big piece of economic news continues to be the question of when do we reopen the economy. Here's a picture from this week's New York newspapers showing a nurse trying to tell a protester, if you protest, please maintain social distancing. And then my concern that was raised 3 weeks ago, and I believe still matters, is the impact of very low oil prices. These are mass protests in Venezuela a year ago. I believe that the potential for social unrest in places like Iran, Venezuela, and Russia that pay for social spending with high oil prices, that social spending might be curtailed, and thus the risk of social unrest might be increased. And finally, of course, we do have the presumptive Democrat nominee now, Joe Biden. So we now have the two most likely presidential candidates being Donald Trump and Joe Biden. So we have three experts to talk about all these things. Dan Melihan is going to speak to three of his expertises. One is US presidential politics, and he became an expert on US presidential politics, and he'll share partly because of his family, but I'll also give him credit that because he's a municipal bond expert, and municipal bonds are where politics and financial markets most directly impact each other, he became an expert in presidential politics. He's also going to talk about active versus passive in the fixed income, i.e. bond markets. And then, of course, he's also going to talk about his expertise of municipal bonds. Dan Melihan works for AB Bernstein, and they're a great municipal bond fund manager. We also have with us Nick Pardini from Davos Asset Management. He's a macro hedge fund manager in Newport Beach, California. And he's going to talk about the ramification of the high US dollar and also low oil prices. Thirdly, we have Jared Metzger joining us from Anuvia Asset Management. Anuvia Asset Management is a socially responsible asset management firm. They look for companies that are doing a great job on gender diversity. And his firm's thesis is that companies who do a good job with gender diversity are more likely to outperform. So that's kind of a screen, and from there they look for companies with good value or growth prospects. With that, we're going to dive in. Dan, thank you for joining us tonight. And why don't you start with your understanding of US presidential politics and the ramification for the markets as things develop?
Tim, thank you very much for giving me the opportunity to be here this late afternoon. For those of you who are listening, if you're wondering if I have a dog in the fight with respect to the presidential election, as far as an investor is concerned, absolutely not. What I think would be helpful for you to know is that I grew up in a household where my dad is right of Ronald Reagan and my mom is left of Bernie Sanders. And I am now 47 years old. So I would say for at least the last 43 years, I thought my parents were getting a divorce every 4 years around presidential elections. A lot of the material that I ended up reading and helping develop here at AllianceBernstein was around me just trying to get through years like this. And if there is one side benefit to the coronavirus taking place right now, at least I don't have to talk politics with them, because that seems to be taking all the air out of the room. So what I want to make sure everybody knows is a lot of you are wondering, do we get better investment results under the left, or do we get better investment results under the right? And I want you to know, since 1937, the average annual return for the stock market when a Democrat has the presidential office is 9.2%. And my mom would say, see, that's why Democrats are better. And then if you look at the average annual return under Republicans, it's 9.1%. Well, in the investing world, we call that distinction without difference, because those numbers are right on top of each other. And we believe at AllianceBernstein that the president gets way too much credit and way too much blame for what takes place in the economy, and especially with respect to the stock markets. So that's kind of my initial thought.
Thank you,
In
Dan.
addition to
Go ahead.
what people also want to know is, well, what's better? Is it better if we have divided government, or is it better if we have unified government? What we found is that if we have divided government, the stock market has an average annual return of 10%. And under unified government, where the Republicans or the Democrats have the House, the Senate, as well as the presidency, the stock market returns 8.2%. And our theory behind that is, when you have divided government, you know that pretty much absolutely nothing is going to happen in Washington, D.C. And when there's certainty that nothing's going to happen, the markets can then make decisions based on nothing happening, and we can plan for the future.
Thank you, Dan. And with respect to certainty and uncertainty, is there a distinction that matters between a president winning re-election and a president not winning re-election?
Tim, that's an interesting question, because if you think through modern times, there are only two presidents that were elected for 4 years and then didn't win re-election. In modern times, you had Jimmy Carter. He was not reelected. And then you also had George Bush Sr. What the two of them happen to have in common is they happen to be presidents during a recession. So going into this year, my dad was excited because the economy was booming, and then coronavirus happened. Well, if we go into this election season and we are still in a recession, then there's a distinct possibility that Donald Trump would not get reelected. On the other hand, if this recession is mild and we come out of it quickly because we all get back to work, there's a distinct possibility he will win reelection because the economy would be going.
Thank you. And where do you see the electoral map now? Do you have a prognostication this early out, or is it, what's your view?
Well, if you look at the electoral map, you really have to stay focused on these Rust Belt states. So it's the Rust Belt states and then Florida. If each one is looking at those areas, I can tell you that Donald Trump will probably not be coming to California in order to campaign. They're going to focus their time in Ohio, Michigan, Wisconsin, Florida, because those are the decision states. You will see Donald Trump on the campaign trail, much like he did the last time, going specifically to those states. What they have gotten very good at is mining big data. So if you think about technology companies and the big data they have available via Facebook, the politicians are very, very adept at using big data, figuring out which counties they need to go to, which people they need to talk to, I would say pander to, and then they can then hopefully swing the election their direction.
That's very helpful. Thank you. And is there any ramification of a Joe Biden win or meaning financial market ramification of it becoming increasingly likely of a Joe Biden win versus a Trump win?
Yes. Tim, in order to touch upon where we just were, the market likes certainty. And right now, they know what they have with Donald Trump. There's certainty there. If we were to see Joe Biden pull ahead of Donald Trump through the debates and into the fall, provided we're through the coronavirus, you would probably see volatility pick up in the markets because Joe Biden would be a change of direction from Donald Trump. And even though he has been in Washington basically for forever, and he was Barack Obama's vice president, it would cause some uncertainty around what his policies would be and how far to the left he would actually go as president. So you bring up a very valid point that if he looks like he's going to win, then you would see volatility more than likely pick up in the fall headed into the election.
Thank you. That's helpful. So one of the things that I was jumping up and down 3 weeks ago was this idea that individual investors should really exit passively managed funds and move into actively managed funds, irrespective of whether US politics causes a new source of volatility. We are in a period of high volatility in the markets. Can you please speak to the importance of actively managing fixed income portfolios versus passively managing?
Sure, and Tim, you wanted me to be really specific in the municipal bond market, so I'll concentrate there. What I want everyone to realize is that prior to 2008 and 2009, the difference between the index, an average muni manager, and an exceptional muni manager was very, very close. And the reason why they were very close, prior to 2008, you didn't have that disparity because prior to 2008, there was a lot of municipal bond insurance out there. So the municipal bond market had a lot of insurance involved with it, and 56% of the municipal bond market was insured. Unfortunately, today, only 6% of it is insured. In addition to that, dealers kept about $50 billion worth of inventory on a day-to-day basis of tax-free municipal bonds. Today, they keep an inventory of $20 billion or less. And then lastly, prior to 2008 and 2009, it was very, very inexpensive to trade odd lots. A $25,000 bond would trade at a markup of around 1.2%. Today, you're looking at 1.6%. So if you look at the municipal bond market, and in particular, the index relative to an average or an exceptional manager, we've seen a massive disparity between the index and an actively managed mutual fund or separately managed account, and primarily because you don't have insurance, so the bonds you own, you have to really know what you own because you're not going to get bailed out by the insurance company. Number two, if you own the bond, you're going to hold on to it. And we saw that 3 weeks ago. The bond market, in particular, the municipal bond market, went almost completely illiquid over the course of a few days. So if you own that bond, you're going to be holding on to it. And then lastly, if you have to trade that bond, if it's less than $1 million in an odd lot, it's going to be very, very expensive, and there are very few people to trade with. So it became increasingly more important after 08 and 09 to have an active manager managing those portfolios who has a very long track record of managing tax-free municipal bonds.
Thank you, Dan. And then the last question I had for you was, I know that you have shared in the past at other venues the idea that you can step down in stated credit quality of the municipal bond and not really have a big increase in default risk. That seems really kind of counterintuitive for a non-expert. Can you just talk through how maybe a BB or BBB rated bond in the municipal bond market compares to a AAA corporate bond?
Absolutely. Tim, what you're touching on is something that's really, really important when you think about fixed income. Corporate bonds are graded on one scale, and tax-free municipal bonds are graded on a completely different scale. So if you were to look at tax-free municipal bonds, and there's a great Moody's study that they update every year, and what it shows is that an A-rated municipal bond defaults about 0.1% of the time, or almost non-existent. And a AAA corporate bond defaults 0.4% of the time. So you can drop from a AAA corporate bond down to a single A or even a BBB municipal bond pick up significantly more yield tax-free and actually not increase the credit risk you're taking in your portfolio, but actually decrease the credit risk in your overall portfolio. And the major reason behind this is because if you are a corporation and you go bankrupt, someone will come in and buy you out of receivership. On the other hand, you're in Newport Beach, California. If Newport Beach were ever threatening to go bankrupt, someone would step in order to make sure that it remains solvent, because all of those people are going to be there. So it's a very, very different mechanism when you look at tax-free municipal bonds and the credit rating versus corporations. What we find a lot of times is investors are very, very gun shy about buying less than investment grade munis, when it's something they should embrace, because they can pick up a lot more tax advantaged coupon and actually decrease their credit risk in their portfolio relative to corporate bonds.
Wow, that's really interesting. So for the taxable portion of my wealth, I should really think about stepping down in stated credit quality in my municipal bond portfolio. What is a national and a well-diversified triple B credit risk portfolio yielding right now on a tax-free basis?
Right now, if you were to buy, say, a triple B or less than investment grade portfolio, you'd be looking at a yield right around 3.8% double tax free. And I'll take it one step further. When I went through the class at Wharton called the Certified Investment Management Analyst, the CIMA program, one of the professors there said, "Hey, Dan, if I ever run into one of your clients and their taxable money is in anything other than tax-free municipal bonds, I'm going to tell them to fire you, because the affluent clients, especially in the state of California, with as punitive as our tax code is, you disproportionately benefit from owning tax-free municipal bonds relative to corporate bonds."
Thank you. That's very helpful. Nick, let's transition over to your areas of expertise. Again, everybody, Nick is the portfolio manager of Davos Asset Management, a macro hedge fund. And Nick has maybe even stronger views than I do of the importance of the low oil price and the high US dollar price. Nick, do you mind sharing with the people tuning in what you think the key ramifications are of what's going on in the world?
Well, in terms of the COVID crisis broadly on emerging markets, I think it basically changes the whole reason that anybody would invest in emerging markets. Prior to this crisis, the main edge in emerging markets was that commodities were cheap, but not cheap enough to bankrupt countries. And you had a low GDP per capita base, which means higher potential growth rates for these economies as they develop consumer classes and increase the education rates of their average citizens. However, due to this COVID crisis, the whole game has changed against the favor of emerging markets. Basically, the combination of decreased travel from developed market tourists, mainly because whether the coronavirus is over or not, there'll just be fear of the next disease, and therefore any country with a subpar hospital system, or what's considered subpar by American standards, will have a major drop in tourism, especially among guests over 40 who don't feel safe. They want to go on a vacation and actually come back. And a lot of these countries are dependent on that. Then there's also manufacturing onshoring due to what happened with key medical supplies and other essentials basically being threatened to be locked out due to being mostly concentrated in China and India, has taught a lot of Western countries the lesson, like, look, we need to onshore our manufacturing. Any critical supplies need to be made at home so that if there's another crisis, we're prepared. And you're going to see tightening of supply chains, and then weak commodity prices. A lot of oil exporters such as Saudi Arabia and Brazil and Mexico have government budgets tied to oil prices and oil revenue. With that down, it's going to cause major political volatility because they can't finance social programs. So it is a triple whammy, because the falling value of commodities and the lack of hard money coming in from tourism weakens the currencies. And then by weakening the currencies, they can't pay their dollar-denominated debt. And fear of that has the currencies weaken even more against the dollar. And it becomes a downward spiral. This was on a more mild scale, starting to happen in 2018, 2019. But this coronavirus might be the shock that really just does it in. And then the other key thing with emerging markets is that classifying countries by developed and emerging markets is not going to be a suitable investment strategy anymore, especially on an index basis, because the correlations are going to change from high GDP per capita countries and low GDP per capita countries moving together to being more correlated with who they align with geopolitically as the world gets more concentrated in two trading blocks, with the trading block of China and its allies and the trading block of the US and its allies and trading partners. This is like the 1989 to 2015 era of like relatively free globalization and everybody trading with everybody was a historical anomaly. Normally, you've been had trade limited to spheres of influences and mercantilist blocks, and we're probably going to trend more that way in the foreseeable future.
And so your understanding that the world might be trending towards one mercantilist bloc centered around China and another mercantilist bloc centered around the US is a really interesting hypothesis and has lots of ramifications. Can you just share maybe one investment thesis that comes out of that?
Yeah, one I think is the one emerging market I think that's going to relatively outperform due to this, especially if oil is down as it is kind of depressed the value of the country's currency, is Mexico. And the reason why I say that is because Mexico is the place where people or American multinational manufacturers, if they want to onshore, but it's just not economically viable, even with cheap energy and automation, to do it in the United States, Mexico is the next best bet. It's geographically close. It has free trade due to being part of NAFTA, and you can have the wage advantage. And so therefore, that's where I think you're going to see a lot of onshoring that doesn't go to the United States in the North American supply chain will go to Mexico. And I think tourism there won't get hit as bad due to its geographical proximity.
That's very interesting, Nick. Thank you. The other kind of big picture situation that you were talking about was that the dollar has received a lot of inflows recently. So the dollar is high versus all other currencies except gold recently. Are there any ramifications of the high US dollar? Are you concerned about the high US dollar, or do you see that kind of stabilizing now that the US might be the new center of a new mercantilist regime?
Well, I think when it comes to the US dollar, my view on it is I think all the major currencies are going to weaken against consumer prices and gold and other precious metals, because every country is going to go all in with extreme levels of fiscal and monetary stimulus. So I think FX volatility will remain the lowest relative to its historic volatility of any of the asset classes, because I think everybody's kind of stuck in this money printing cycle indefinitely. But yeah, there will be problems, but I think every country is going to be printing, so I don't know how much you're going to actually see it in terms of a strong dollar.
Okay, thank you very much. I just want to remind everybody on the call, if you have any questions, please use the chat function. You could highlight chat, and then a chat box will show up on the right-hand side. We're starting to get a few questions, and if you have any, please direct them. You'll see the TO box. Send them only to me. You'll see me there as one of the co-hosts, Tim Shaler. Thank you, Nick. Let's transition over to Jared, who's our sitting expert tonight on active choosing of stocks in the U.S. stock market versus passive, which is the strategy where folks are not actively choosing stocks that are expected to outperform. Jared, thank you for joining. Do you want to just speak a moment on the importance of active shareholder fund management in times like this where we have a heightened degree of volatility?
Yeah, absolutely. Thank you, Tim. I think when you think about the key difference between passive versus active management, especially against the current macro backdrop, is an active manager is going to have more tools at their fingertips to manage that increased risk regime. Namely, they're going to be able to leverage economic data, policy developments, fundamental analysis, and technical trends to determine which securities they should buy, hold, or sell.
Thank you. And so now during periods like this where we have particularly high volatility, typically from what sectors are active portfolio managers moving and into which sectors are active portfolio managers moving?
Yeah, typically when we get in to this kind of environment, what you want to see is you'll see managers moving out of energy, financials, industrials, really sectors that are cyclical in nature, and moving into more defensive sectors. Historically have been utilities, consumer staples, healthcare, and technology. And that's held true through this crisis as well.
Right. And so if that's what's typical, how do active fund managers such as yourself anticipate the market rebounds so that you and people like you can try to outperform when the market does rebound?
Yeah, I think, speaking to the coronavirus situation we were in, a metric that we were using was new cases. And we focused a lot on Italy and on the idea that Italy would be sort of a game plan for how things would develop in the US. And it's interesting that if you look at new cases on a day-over-day basis in Italy and the S&P 500, they're effectively negatively correlated. And as soon as you saw peak new cases in Italy, that was when the S&P 500 bottomed out, and you kind of saw that risk reversal as guys started to add risk to their portfolios.
That's great. So 3 weeks ago, I was talking about the importance of paying attention to the third derivative, by which I meant we need to pay attention to the change of the change. And so it sounds like you were using actual data from Italy to monitor that. And as you saw new cases, the number of new cases dropping in Italy, you were anticipating a turnaround in the US market.
Absolutely. And you saw that play out. And again, right, when we think about equities, you'd like to think of equity market being a leading indicator for what's going to happen down the road. And so we saw that.
Are there any other aspects of active versus passive management that you would like to point out to the people on the call?
Yeah, I think another thing that is advantageous to investors when using an active manager is that manager's ability to short sell or use put options to limit downside risk. And on top of that, one of the things that we do here at Anuvia is, on top of being an active manager, we're also activist investors, which means that we engage with our portfolio companies' management teams to try and influence how they are managing their business, with the idea being that a sustainable investment is a better investment over time.
That's great. Thank you. And the strategy that you're using now is focused on gender diversity, and I know that you have others that you'll be rolling out as well. But I would just point out that there are quite a few companies similar to Anuvia where they focus on some sort of key indicator that may lead to outperformance. So a great portfolio would have a well-diversified portfolio of those sorts of inputs, which in academia we would have called multi-factor portfolio management. So the first question that we're going to transition to, we'll stick with you, Jared, is assuming that almost all the people on the call are at least sophisticated investors, even if they are not accredited investors, what kind of generic suggestions could you give to those sophisticated investors?
Sure. I would say right now my recommendation would be to increase the quality of your portfolio. I think you've heard a number of the guys on the call tonight talk about an increased risk regime or increased volatility, and you kind of see that out through the VIX curve when we look at that. And so what I would mean is specifically use this opportunity to sell off maybe riskier companies, highly leveraged companies, and move into factors such as size, profitability, and growth, because those companies will be best positioned to outperform both going through this and coming out of it.
Thank you. And Dan, what advice would you give to that same sophisticated but not necessarily accredited investors?
If I were sitting down with a sophisticated investor, but maybe not accredited, the first thing I would ask them to do is, given that we don't have to pay our federal income tax until July, is I suggest that they take a look at their federal income tax. And specifically, I would tell them to look at line 2B. Line 2B is where you have your taxable interest that shows up. And I would tell them to sit down with their advisor, look at line 2B, and try to get everything that would show up on line 2B over to 2A, which is your tax exempt interest. In particular, I think that given the volatility we saw last month, which was a massive dislocation in the municipal bond market, towards the tail end of March, we saw about 13,000 to 15,000 tax-free municipal bonds out to bid. When on a normal day, we would see 2,000 to 3,000. Municipal bond market basically illiquid over the course of about 10 days. And because of that, it created tremendous buying opportunity for a really talented manager to buy bonds in the triple B area or in the high yield area, where they can pick up significantly better yield today than they've been able to pick up since maybe back when Meredith Whitney in 2010 said all municipalities were going to be going bankrupt. So I'd look at line 2B, try to move that over to 2A, work with a talented investment professional as well as an excellent active manager to pick up some of those really, really good opportunities in the tax-free municipal bond market.
Thank you. And Nick, what would you suggest to that sophisticated but not necessarily accredited investor?
Yeah, it's tough because I don't really recommend short selling to non-professional investors, even though I think there are a lot of opportunities right now on that side of the market. So, I mean, I think the thing I mentioned is just investors need to factor in volatility, because when people think they're diversified in safe stocks and bonds and a lot of things that are serially correlated, they're basically all the same trade, which is being short volatility. And so you got to have some sort of long volatility assets to go against it, whether it's buying precious metals, whether it's buying some sort of like protection on your portfolio. But I think VIX is too high to do that, or just keeping your size lower. That's really what professional managers do. When vol is high, you just trade smaller positions. I think it is a good time to be in cash, because I think you're going to get another sell off. I'm not sure if it will quite retest the lows, but there will be a better buying opportunity. And I think the real bottom is when you see a higher level of volatility as measured in VIX and MOVE and other volatility measures, but with a lower low in price. And that's kind of the key thing I'm looking at in terms of when this market's going to finally bottom out.
Thank you. So the three pieces of advice from our three experts, the one from Dan is move your income from line 2B to line 2A. The advice from Nick is keep some cash so that you have some money with which to buy possibly lower priced investment opportunities in the future. And Jared's suggestion is move up in quality of companies as measured by profitability and lower debt. We do have a lot of questions coming in on the chat box. I want to get to some of those, but I wanted everybody on the call to know that this was kind of the part that the four of us had kind of prepared ahead of time. So if you need to hop or have dinner or help the kids with their homework that you gave them earlier today, now would be the time to drop off. But we probably will field 4 or 5 questions to each of our panel of experts if you can stay on for another 15 or 20 minutes. One set of questions for our panel of experts, Jared and Nick and Dan, is commodity prices. So one question is, what is the best way for a retail investor to own gold? If we're saying that all currencies might go down versus gold in the future, what's the best way to express that for a retail investor? And two, how do we think about the opportunity to buy commodities? And I'll just add to that question that came in, including oil. So it would have been great 7 days ago to been paid $13 if you were on the other side of the contract. That opportunity is gone, but what's the best way to express oil and gold and other commodities? And what do you think about those opportunities? All three of you, just speak up when you feel you have a good answer.
Okay, I'll start. When it comes to gold, I think the best way for investors to buy it at this point is through a GLD ETF. It is backed by physical gold, and if you try to go buy physical from like a dealer, you're going to get ripped off because they're raising the spreads due to a combination of mint shortages and just the dealers capitalizing on just the general fear in society. So yeah, I mean, I'd go with just the GLD in terms of buying if you want to buy gold. In terms of other commodities, it really depends. I mean, the problem with buying futures contracts is that there is a lot of implicit risk and leverage, which I don't recommend non-professional traders really to deal with. And the ETFs have a lot of built decay. So if you want to buy a particular commodity, I would be buying companies that have the lowest break-even price of production in that given commodity. Like, for example, or the ones that have the best market share or financial statements. So if you want to buy like meat, you just try to buy the best quality meat producing stocks. Or if you want to buy oil, just buy whatever oil companies have the lowest break evens. Because the risk is that there's going to be a lot of these higher cost producers are going to go bankrupt, and you don't want to be stuck in a company like that or an ETF that has a large allocation to those.
Thank you, Nick.
Hey, Tim,
Dan or
I'll
Jared?
piggyback on that.
Thanks.
Because what Nick brought up is really valid. If people don't know, one of the largest ways to play oil is OIL, which is an ETN, and Barclays is the issuer of that ETN, and they announced yesterday that the ETN is just going to be liquidated. So you run the risk when you buy an ETF or an ETN, as he mentioned on the decay, that they may in fact actually liquidate it or delist it. So it can be very, very volatile. I'll add one thing to his point, which is if you do believe the price of gold is going to go up, historically speaking, the miners are levered 3 to 1 on the price of gold, at least on the initial move in the price of gold. So if gold moves up $1, the miners tend to move up 3 to 1 initially. Then over time, what the miners will do is they will hedge, and then you'll see a breakaway from that 3 to 1 movement. So maybe owning, GLD and then a basket of the miners to give you that 3 to 1 leverage on the initial move in gold would be an idea.
Thank you. Jared, do you want to add anything to this discussion on how to get exposure to commodities?
Yeah, I think that your other two panelists covered it fairly well. I also would recommend GLD, highly liquid, backed by physical, or the miners. I think in terms of oil, to add to what Dan had to say, you are actually seeing the largest oil ETF, USO, is going to be restructured because of their role in this whole catastrophe over the last few days when they needed to roll their futures, and the fact that they accounted for, depending on which estimates you believe, 25 to a third of the futures market rolling from May to June. So I would sit tight and see how the ETFs play out in the oil space. There's a lot of uncertainty there. And so my recommendation would be best expressed to invest with oil production companies with the lowest cost per barrel of extraction.
Thank you. That's so those are both all those comments were great. So I want to switch over to a municipal bond question. Sorry, guys, but this one's probably only for Dan, Nick and Jared. But Dan, one of the questions is Mitch McConnell has basically said we should allow states to go bankrupt. What ramification do those sorts of comments have on the muni markets and government bonds? When we were talking earlier, you also talked about revenue bonds versus GOs. Maybe you can touch on that if you think that's relevant.
Sure. Well, first and foremost, it does have ramifications. If you look at the municipal bond market, as soon as that statement was made by Mitch McConnell, muni sold off about 0.5%, finished the day down about 0.5%. And you bring up another valid point, is when we look at the municipal bond market at Alliance Bernstein, there are two types of municipal bonds in general. You have general obligation bonds. Those are bonds that are backed by the full faith and ability for the government to tax us into the Stone Age. And then there are revenue bonds. So when we build portfolios at AllianceBernstein, we build a portfolio that's 90% revenue bonds and only 10% general obligation bonds. And the reason why we do that is the revenue bond has a revenue stream associated with it based on some sort of aspect of commerce. So let's say we have a water bond or a sewer bond or a power bond. The economy goes down, people still pay the water bill, they still pay the sewer bill, they still pay the power bill. That revenue stream is going to continue to come in. And quite often when those bonds are issued, we get 3 times coverage or 2 times coverage. So even if revenue were to drop by 66%, there would still be enough revenue coming in order to pay those bonds. I think along the lines of what Mitch McConnell said, and I am certainly not a publicist, I believe what he was trying to say is if you think the federal government is coming to bail you out after coronavirus, you can think again, because we're not coming to bail out states that were not judicious with their money. It's also really important to keep in mind that here in California, even though I never think of California elected officials as being frugal, if you look over the last couple of years, whether it was Jerry Brown, Moonbeam, or our current governor, Gavin Newsom, we're sitting on about a 15% surplus for our budget. So between 15 and $20 billion of excess money that we have sitting on the books. We've gone into this downturn better than we've ever gone into any sort of recession in the history of the state of California, but it does have an impact.
I actually do have a comment on muni bonds. I mean, I think you need to do is look at states that have reasonable pension balances and liabilities and states that income is not overly tied to one sector. Like, I mean, it's probably the best run states in terms of their pension balances are Oregon, Wisconsin, and South Dakota on that front. And there's certain states whose income is going to be devastated by this crisis, such as Alaska due to their dependence on oil, Illinois due to the fact that they were already at just 39% funding status to their pension before this whole thing. And in California, who has a large chunk of its tax revenues depend on capital gains, particularly sales of tech companies, to, whether they're private or the public markets. And if you don't see a new all-time high in NASDAQ by the end of the year, that buffer is going to be more than wiped away very quickly.
Thank you. Jared, did you want to add anything to this part of the discussion?
Well, I think if you were, looking to buy munis, one of the things you could think about was the facility that the Fed has set up, which really ends up benefiting the largest cities and counties in the country, because you would see that then with their $500 billion that they've allocated to that, you probably see a better liquidity profile in terms of if you want to own and get out.
Thank you. Another question, I don't know if any of us are expert in this, but one of the viewers asked, given the sell-off that's happened, is this a good time to think about intergenerational transfer of wealth through gifting and other means, moving assets into trusts and those sorts of things? Do any of you have any expertise or comment to address that?
So Tim, I think, we work with a lot of very, very affluent clients. And if you have highly appreciated securities that you were thinking about doing some sort of gifting, and those securities are down, I would really tell them that that's a topic that they should focus on with their advisor and their estate planning attorney simultaneously. Also with their accountant. I think those types of situations are when you want all 3 of those people sitting in the same room at the same time in order to help you make better decisions. Now, right now, you may not be able to sit in the same room at the same time, but you can at least Zoom together and make a much, much better decision on that with all 3 parties in the room simultaneously, or at least via Zoom.
That's helpful. So I think to wrap up very quickly, I think the general thesis remains: move from passively managed funds to actively managed funds. And the thesis is extended by saying, if you have fixed income in your taxable portion of your wealth, very strongly consider moving some of that into municipal bonds, especially if you can buy revenue bonds and step down in stated credit quality without giving up much in actual default risk. I think also, to the extent that you are an accredited investor, it would make sense to consider alternative assets like a macro hedge fund and socially responsible investment funds. But I think most importantly, the benefit of active bond managers, macro managers, and equity stock managers is that we are in a time of heightened volatility, primarily because of coronavirus and when and whether we're going to reopen the economy, but also because we have new sources of volatility with really low oil prices, potentially leading to recalibrations, maybe around new mercantilist blocks like Nick is suggesting, one around China and one around the US, which might have all kinds of other ramifications. And really good, active portfolio managers and fund managers will help you go through that process. So with that, if Dan and Jared and Nick, if you want to provide any kind of closing comments, you're welcome to do so. And then with that, we'll wrap up.
My only closing comment would be that as we get closer and closer to the election, remember that what makes the country great are all of us who go out, create, and produce for this country. This country's great in spite of the elected officials that we have. And just remember that as you head into election season, because the rhetoric is going to get very, very loud. And just remember that we are the reason why this country excels, not our elected officials. Thank you, Tim, for inviting me.
Thank you, Dan. Nick?
Yeah, I think just in general, even though I think we're close to the bottom in terms of the health impact of this crisis, like I think that we've seen the worst in terms of a lot of the death tolls and risks on that side. However, well, the economic consequences are yet to be seen because everything's been locked down. Nobody really knows what the activity is going to look like once things are open and what dominoes are there to fall. First, you've seen a few corporate defaults on smaller end. You've seen oil go down. Like it seems like there's been a new shoe to drop at every step of the way so far. And I just think is that it's just time to got to be a little bit more conscious about risk management and being on both sides of the market, I think, at this point.
Thank you, Nick. Jared?
Yeah, absolutely. I think I would stay focused on the consumer, watch initial jobless claims and continuing claims to see if the consumer can hold up and bring us out of this kind of as strongly as we went into it. And then I think lastly, I would just thank you and GIVSUM and Fish for Life for the opportunity to be here tonight.
Thanks, Jared. So just to remind everybody, if you thought this was helpful, please go to the GiveSum site and consider a donation to Fish for Life. And I will add that one of the things that I still very strongly recommend is if you can get a refi on your home, you might have to go to a private banker to get through the mess of getting a credit extension right now, but because they are overwhelmed with all the credit applications that are going on. But we literally are at all-time lows going back to the founding of the U.S. Republic in 1792. So to the extent that you can, please do get a refi on your home, and happy hunting, and please look for news of when we do this again. Thank you, everybody, for tuning in.